If you're a landlord in the UK, you need to listen up. Because 2026 isn't just another year on the calendar. It's the beginning of a massive shift for your properties, your profits, and your finances. We're about to break down the biggest tax traps heading your way, and, most importantly, what you can do about them. Right, let's get into it.
And trust me, that's not just hype. It doesn't matter if you've got one rental flat in London or a whole portfolio across the country. The systems you use, the tax you pay, and how you report it all to HMRC, it's all about to be completely transformed. So the real question is, are you actually ready for what's coming? So to help you get ahead of the curve, we've teamed up with the experts over at My Tax Accountant. They've put this whole briefing together, and their insights are going to give you the clarity you need to not just follow the new rules, but to plan smartly for a very, very different future.
Okay, here's what we've got on the agenda. We'll start by setting the scene for this new tax era. Then, we're diving into 4 huge traps you need to know about. The digital reporting trap, the direct hit on your profits from new tax rates, some major pitfalls when buying new properties, and a massive shakeup for anyone with a holiday let. And don't worry, we'll wrap it all up with a clear action plan you can start using today.
So let's kick off with the big picture. Why is all this happening right now? Well, these aren't just little tweaks to the numbers. We are talking about the biggest change to how property income is taxed in more than a decade. And it's all being driven by one very clear goal from the government.
At its heart, this is all about leveling the playing field. The government's looking at the tax someone pays on their salary from a 9-to-5 job, and then looking at the tax paid on income from assets like property, and they're saying, hang on, that gap's too wide. These changes are designed to make sure that profit from wealth is taxed more like a wage from work.
Okay, let's get straight into our first big trap, the mandatory switch to digital reporting. It's called Making Tax Digital, or MTD for short, and honestly, for many landlords, this is the single biggest headache coming their way. The days of stuffing receipts into a shoebox until January, yeah, those are officially over.
So what on earth is MTD for ITSA? Well, it's HMRC's new system, and it demands 2 key things from you. First, all your financial records must be kept digitally. And second, instead of filing one self-assessment tax return each year, you'll now have to send tax updates to HMRC every 3 months, using special government-approved software.
And look how quickly these deadlines are coming up. From April 2026, it's compulsory for any landlord with rental income over £50,000. But that's not the full story. Your first quarterly update is actually due just a few months later, in August. Then, a year later, in April 2027, the net widens to catch everyone earning over £30,000. This is happening, and it's happening fast.
This new MTD cycle completely changes the rhythm of doing your taxes. It's no longer a once-a-year scramble. It's an ongoing, year-round job. You'll need to log income and expenses pretty much as they happen, send off those 4 quarterly updates, and then, at the end of it all, submit a final declaration to tie everything together. You're going from one big deadline to 5 smaller ones.
And here's a pro tip for you, and it's a big one. Please, do not wait until the last minute on this. Start looking into MTD-compatible software now. Think about what you need. Do you want something that links to your bank account? Or an app that lets you scan receipts on your phone? Finding the right tool today is going to make your life infinitely easier in 2026.
And yes, there is a cost. You might be wondering how much this will set you back. Well, HMRC estimates that the average one-off cost to get a business ready for MTD is about £320. That could cover your software, maybe some training, or professional advice. It's a real cost you need to budget for.
Right, let's move to our second trap, and this one hits you right in the wallet. On top of all the new admin, the government is bringing in a totally new way of calculating the tax on your rental income. We're talking about new, higher tax rates designed specifically for landlords.
So, the million-pound question on every landlord's mind is, how much more is this actually going to cost me? Now, these new rates don't kick in until April 2027, but knowing how they'll affect you now is absolutely crucial for your future planning.
So the massive change is this. Your property income will now have its own separate tax rates. It's no longer lumped in with your salary in the same way. And as you can see, every single band is going up by 2%. The basic rate jumps from 20 to 22%, the higher rate from 40 to 42%, and the additional rate goes all the way up to 47%. It's a straight-up tax hike across the board.
Okay, stay with me, because this next part is absolutely critical, especially if you're a higher rate taxpayer. It's a double whammy. That's not all. Here's where most people get caught out.
The tax credit you get for your mortgage interest will now be limited to the new basic rate of 22%. So not only are you paying more tax on your profits, but the relief you get back is actually worth less. It's a real pincer movement on your profit margins.
And this isn't some niche issue affecting a handful of people. The government's own figures predict that 2.4 million landlords are going to see their tax bills go up because of this. That is a huge number of people, and it's a change that will ripple right across the private rental sector. Now let's look at what happens when you buy a property.
Okay, let's talk about trap number 3, which is all about the act of buying property itself. The tax you pay on purchases, stamp duty land tax, or SDLT, has also had a major overhaul. Popular tax-saving routes have been shut down, and that's put the focus on some really complex areas of the law.
One of the biggest changes was scrapping something called multiple dwellings relief, or MDR. For years, this was a lifeline for investors buying, say, a block of flats, because it let them pay a lot less stamp duty. As of June 2024, it's gone, and that's a major blow for anyone looking to expand their portfolio. With that door closed, the spotlight has swung right onto another area: mixed-use property. This is basically a property that has both residential and non-residential bits, like a flat over a shop. The key thing is, the entire purchase gets taxed at much lower commercial stamp duty rates. It's incredibly valuable, but this is exactly where the new traps are being laid. And this slide just shows how risky it can be. People have tried all sorts of creative arguments to get their property classed as mixed use, and the courts have thrown them out. A local farmer grazing his cows on your land? Not a commercial use. That office you use over the garage for working from home? Nope, still residential. Getting this wrong can be an incredibly expensive mistake. That brings us to our fourth and final trap, and this one is aimed at a very specific group: owners of furnished holiday lets. For years, this has been a golden area of property investment, with a whole host of tax perks. Well, that's all coming to a screeching halt. The headline is simple and pretty brutal. From April 2025, the entire furnished holiday lettings tax regime is being abolished. That's it. All the special rules that made holiday lets so attractive from a tax point of view are just going to disappear overnight.
So what does that actually mean in practice? Well, two of the biggest advantages are gone. First, you lose the ability to claim generous capital allowances on things like furniture and fittings. That's being replaced with a much less valuable relief. And second, all those brilliant capital gains tax reliefs that treated the property like a business, they're gone too. From April 2025, a holiday let is taxed just like any other house.
But it's not all bad news. Here's a did you know for you. There is a useful little detail in the new rules. If you've built up any losses from your holiday let business, you can carry them forward and use them to reduce the profits on your other UK properties after April 2025. It's a small silver lining, but it means those losses won't be wasted.
Whew, we have covered a lot of ground, and it's clear there are some serious challenges on the horizon. But every challenge needs a plan. So let's break down exactly what you can do to navigate all of this with confidence and hopefully stay one step ahead of the game. Here is your simple 5-step checklist. Number 1, go digital now. Don't wait to be forced into it. 2, model your 2027 tax bill. Sit down and work out what those new 22, 42, and 47% rates will do to your bottom line. 3, review your structure. Is owning properties in your own name still the best way, or is it time to look at a limited company? 4, get expert stamp duty advice before you even think about buying again. And 5, which ties it all together, seek proper professional guidance to build a solid plan.
Now, it's really important for us to say that the information we've discussed here is for general purposes only. Your own situation is unique, so you shouldn't rely on this exclusively to make big financial decisions.
Ultimately, the takeaway is this: the tax world for landlords is changing in a fundamental way. The rules are more complex, and the financial stakes are higher than ever. The only real question is whether you're going to be reacting to these changes after they happen or getting ahead of them with a proper plan. If you want to get on the front foot and get expert help to navigate all of this, then get in touch with the specialists at My Tax Accountant. You can call them on 0208-570-8531, or you can drop them an email at info@mytaxaccountant.co.uk.